Weston for his view from IG Markets in Melbourne. To what extent does that at all support this market today, Chris? We're all pleased to see that iron ore price bounce. It just doesn't seem to be playing out in a significant way when you look at some of those material plays.
Yeah, I think it's got to be a good thing that we're seeing prices now 10% from those lows. I mean, we got down to 86.70 a few days ago, and then we're back up to $95 per metric ton. But there's other things you can look at. You can have a look at the Cape size shipments as well. I mean, they've been improving, and you can have a look at hot rolled coil, which effectively is the actual steel price, and that was up 3.7% overnight as well. So yeah, I think we've been talking about it for some time that the iron ore price has been an absolute free fall. There has to be a supply side response at some stage. We're starting to see that. I talked this morning about some of the initiatives that go, or some of the situations that are happening in Goa. Goa is one of the biggest producers or exporters of iron ore globally. I mean, they export about 50 million tonnes a year. So there's a temporary halt there as well, again feeding into the supply side constraints. And obviously you've got the infrastructure side of things, which really boosted some of the base metals last night. Copper had quite a nice gain. So I think that's still playing into it. Obviously we want to have a look at what's happening in Shanghai today. Yeah, I think we've had a very strong gain in some of these names, as perhaps some of the CEOs that we've seen from Atlas Iron, from BHP, and obviously from Ned Power as well. They're saying that the iron ore price should be going up again, up to the sort of 100 in Atlas's case, up to 120 with Ned Power's view. And perhaps we've just seen that snap back now. Everyone's sort of pausing for breath. But I think it's it's one of those situations today. It's good to see the market coming off the lows. I think we traded down to about 43.16. We've pushed back up to 43.30 where just before I came on air. So it's good to see some buying from that low. 43.15 being a reasonably strong technical level in our market today. US futures have seen some modest upside, and we're seeing a little bit of buying coming in the euro. And I think euro is going to be a very important cross for a lot of different things over the coming days and into obviously the FOMC at the back end of the week as well. So a bit of buying in euro. I think that's given us a little bit of license to buy into some of these equities as well today.
Yeah, gold is a popular trade, it goes without saying as well. Are you kind of seeing enough support in that space in terms of some of the Newcrest of this world and the smaller entities to say that there's enough awareness of the attractiveness of that trade, particularly with the inflation call that's being baked into another drop on stimulus from the Fed?
Well, I think if you look at our client base at the moment, Carson, most of our clients, the predominant bulk of them are actually long gold at the moment. I think most of them will come up to the view that we are going to see some stimulus measures. Now, there's a lot. It's not so binary. I spoke this morning about the binary event that is going to be the ESM. I mean, we're either going to see that being voted through, or perhaps there could be a referendum. Both of those, if we get a no vote or a referendum, both of which case I think people will come out and really go heavily short euro, and I think we'll see that have a monster decline in the short term. But it's about the non-farms in terms of gold. Now, the ECB, obviously, under their OMT programme, will be doing this unsterilised, or sorry, it will be sterilised. If it was unsterilised, I think gold would have had a much bigger bounce than what it's had at the moment, given the expansion in the money supply that would be coming through. The fact that it's going to be sterilised is probably works against gold, or certainly the upside. But it's about what happens with the Fed. I mean, there's so many different bits and pieces that we want to see with the Fed. I mean, are they going to come out and initiate and actually give a full-blown package? I.e., we're buying 500 billion plus of different assets, and then we need to know the breakdown. Are we buying just mortgage-backed securities, or is there going to be a mix of mortgage-backed securities and US Treasuries? And then we need to know the duration that's involved as well. So it's not as clear-cut there. I mean, there could be just a situation where they say that we can have an open-ended project doing 50 billion a month, and we just don't know how long that's going to go on for. And that may not be as positive for gold as perhaps it should be. So it's not as black.
One thing we do know is what the world looks like today versus what it looked like in 09. Now, crudely put, it's not half as bad, right?
No, that's exactly right. Now, I think the first thing here is that Bernanke's categorically stated we will be printing on the back of the employment picture. We want to see a substantial and sustainable number. Now, the non-farms we got on Friday at 96,000 is very much in line with the 6-month average at 97,000, and it's significantly below the previous 6-month average at 205. So clearly, it doesn't fit into that sustainable and substantial number.
So you're saying he's just basically fed up now. He's had so many of those lukewarm prints. He's saying, to hell with it. I've got no other option but to dump.
Well, why would he wait? I mean, why would he wait till January and December to do it than September? Okay, you've got the political aspects, but that potentially plays into this meeting. But he looks at the long-term picture now. if you look at that 6-month average that I just spoke about, it's just it kind of says to me that the next 2 months are going to be pretty soft as well. There's no real reason, if he's looking at the long-term projections, and given that core PCE is still below his 2% target as well, there's no real reason for him to wait. September should be the month that he does this. He's given enough indications with his hard-hitting, grave concerns words. So I think that's the issue. But going back to your original point, there are clear differences between now and 2009. I mean, if you look at the market, there was disinflation. People were really worried. So he had to come and stimulate to create that reflation trade. At the moment, inflation's not a particularly strong point, but he doesn't need to be concerned about it either way. And I think your stock prices were obviously a lot lower, even though that's not part of their mandate. And I think the big issue, the big difference between 2009 and now is liquidity. I mean, there's clearly excess liquidity still in the system, whereas in 2009 there was no liquidity, credit was dry. And I think that's what some of the sort of QE3 bears are saying, you know, that is the major differences. But Bernanke's made it categorically obvious that he is really worried about employment, and that employment rate at 8.1% showed the lowest participation rate in about 30 odd years. So to me, if he's going to do it, he should do it in September, regardless of whether there's an election in place, rather than wait to December to January. And I think he's built a massive rod for his back in just his commentary that something really should happen sooner rather than later.
Indeed, will all be revealed very soon, and we will talk soon.
Well, despite the overnight bounce in iron ore, as we've just been talking about with Chris, it's still a relatively low price, and it could still cost Australia more than $15 billion in export revenues and punch a $3 billion hole in the federal budget.